Some landlords take pride in owning real estate, while other landlords consider the monetary benefits. Whatever your reason for buying property, you should always want to maximize your benefits. After all, you have invested a substantial amount of time and money, you should get something back in return. So, how can you maximize the return on your investment? One option is to know which tax breaks are available to you as a property owner so you can take advantage of them. 1. Interest rate. Interest is typically the single largest deductible expense from the rental property tax deductions worksheet. Landlords can deduct mortgage interest payments on home loans or interest charged on credit card purchases for goods or services used for rental property upkeep. The Tax Cuts and Jobs Act limited the tax write-offs for landlords who have rental income of more than $25 million. But, if landlords agree to depreciate their rental property over 30 years instead of 27.5 years, they can avoid that limit. 2. Depreciation for rental units. The market value of a rental unit or apartment building is not fully deductible from the rental property tax deductions worksheet in the year in which you pay for it. Rather, landlords can get the money spent on real estate investments back through depreciation. That means the landlord deducts a portion of the cost of the property as rental property repairs tax deduction over several years. 3. Rental startup expenses. If you plan your rental property business, you might be able to deduct a portion of your startup costs. Landlord deductions for business startups include accounting fees, new employee training fees, office furniture, and staff salaries. Although most startup costs are considered capital expenditures, rental property tax deductions may account for as much as $5,000 of those costs, even if startup costs exceeded $50,000. 4. Reasonable advertising expenses. There are plenty of options for landlords' tax reductions if you look for them. Landlords can deduct advertising expenses incurred when advertising rental units. This typically includes the cost of postage for mailers, classified ad space, money spent to advertise the space on social media platforms, or signs. You can even deduct the costs of building a new website from landlord tax. 5. Home office. Claiming home office deductions is a bit tricky. That's why many landlords seem to ignore it. But it can turn out to be extremely valuable and worth considering if you don't mind the many nuances. You can deduct expenses like office furniture, tools, or costs like home maintenance or utilities. However, before taking advantage of the deduction, consult with an accountant to be sure you understand the minimum requirements that would qualify you for this type of deduction. 6. Utility bills. Landlords often have to pay bills for lighting a common area or to provide security for their rental property. There is an opportunity to convert these expenses to tax write-offs for landlords. You might qualify for a tax deduction if you replace old energy-consuming appliances and equipment with smart energy-efficient ones, like replacing a 10-year-old water heater or 15-year-old HVAC. However, before you purchase or intend to deduct tax, consult with an accountant or review the federal tax credits. Some common rental property tax deductions include mortgage interest, property taxes, insurance premiums, repairs and maintenance, property management fees, utilities, advertising expenses, legal and professional services, depreciation, and travel expenses related to property management.